Good day, and thank you for joining us to discuss the role of fintech in the pursuit of financial security for Americans. My name is Letty Nocera, and I'm the Senior Manager of the Bipartisan Policy Center's Funding Our Future Coalition. Funding Our Future is a national coalition of over 60 partner organizations across the nonprofit, academic, trade association, and corporate sectors dedicated to improving financial and retirement security for all Americans. We are pleased to host this event at the beginning of America Saves Week, an annual call to action for individuals to commit to successful saving practices. According to new Harris Poll research commissioned by Funding Our Future and Daily Pay, 62% of U.S. workers feel anxious about their current financial situation, despite signs of slowing inflation. A majority, however, cite that they would find fintech products helpful for managing their personal finances, such as those that consolidate banking needs, automate emergency savings, provide real-time earned wage access, or offer free financial coaching. This research welcomes a discussion about what the industry is accomplishing, as well as its evolving policy landscape in facilitating innovation while protecting consumers. Before we get started, I would like to thank all of our coalition partners, and especially our executive partner, the Charles Schwab Foundation, for making this event possible. Throughout the conversation today, please feel free to participate and submit questions via YouTube's chat function or on Twitter at BPC_bipartisan using the hashtag BPCLive. At this time, I would like to introduce Rachel Snyderman, Senior Associate Director of BPC's Economic Policy Program, and Susan Weinstock, Chief Executive Officer, Consumer Federation of America. Over to you, Rachel.
Thank you, Letty. On behalf of the Bipartisan Policy Center, I am honored to virtually welcome Susan Weinstock today. Susan is someone who has dedicated her multi-sector career to advocating for consumers. And in her role right now, she serves as CEO of the Consumer Federation of America, which is an association of nearly 300 nonprofit consumer organizations that really represent the voice of American consumers in the education and policy process. Her expertise in consumer protection spans advocacy, communications, research, and grassroots organizing at all stages of individuals' savings and consumption journey, from those just beginning and entering their workforce to those planning for and in retirement. So Susan, it is a pleasure to have you here with us today to share your insights and expertise. But before we dive in to really look at the intersection of fintech and financial security, I want to draw the audience's attention to a note that Letty opened with, that today really kicks off America Saves Week 2023. It's really exciting. This program is in its 16th year, which I think is absolutely incredible. And I was hoping that you could provide a bit more context around the importance of this week and CFA's role in establishing its legacy and what's in store, particularly this year.
Yes, thank you, Rachel. Your timing could not have been better. So America Saves Week has been an annual celebration since 2007, and it's a call to action for everyday Americans to commit to saving successfully. Through the support of thousands of participating organizations, we encourage our local communities to get clear on their finances and on their savings behaviors. And then the America Saves Pledge is the framework that allows savers to set a goal and make a plan and achieve that better financial stability. America Saves uses the principles of behavioral economics and social marketing so that they can, we can encourage and motivate and support everyday Americans to save money and reduce debt and build wealth and create better financial habits. Thousands of nonprofit, government, and corporate organizations partner with us through local and regional and statewide and national campaigns, both year-round and then, of course, most importantly, during America Saves Week. And we have daily themes. So let me just run through those so that you can know what's going on for this year. So today, our theme is Saving Automatically. Tomorrow, Tuesday, is Saving for the Unexpected. And we're going to be launching our brand new podcast called The Savings Advocate. This is a partner-focused podcast for people who work in the personal financial space and want to work through their organization to help individuals become more financially stable. And then on Wednesday, it's Saving for Major Milestones. This is going to be when we're going to release a workshop on spending and savings plans. And this is going to be on demand, so you don't have to watch it on Wednesday if you don't want to. It's going to walk through the budgeting process, help people review their income and expenses to get a clear view of where they are now, and help to build those confidence and that tools to get where they want to be. And then Thursday is paying down debt is savings. This is going to be a webinar on the future of workplace savings programs from a subsidiary of America Saves called America Saves at Work. And participants are going to learn about resources and services that are available to help employers start or expand their financial wellness programs for employees. And then on Friday is saving at any age. And so if you want to learn more information, please go to americasaves.org.
Well, thank you so much for really walking us through and laying out what the week ahead will look like, because I think that this is the exact time to be talking about where we see, fintech intersecting at all of these different themes that we're rolling out this week. Because, we've seen polling, for example, that shows that a number of consumers are in fact turning to fintech solutions instead of traditional banking and wealth management to really make ends meet and to help them with their financial services needs. And so, on that point in particular, I wanted to dive in with you a bit deeper about, just because the availability of these products exists, we're seeing that doesn't always translate into take up. And so, what are some of the issues faced by consumers today that you would like to see the industry address as it continues to evolve?
Sure. Well, innovation certainly has an important role in the financial marketplace, and we've all seen that. We just want to make sure that it should be pursued in a way that's consistent with and enhances consumer protections. So it shouldn't shield innovators from enforcement and supervision or limit state and federal regulatory authority. That's very important to us. But access, cost, and privacy are a few of the issues consumers face when thinking about or using fintech products and services. So since most fintech products are offered through a smartphone or through a computer, having access to high-speed internet and a smartphone or a computer is really important. So lack of that access can, affect different populations differently. For instance, if you're in a rural area or in an inner city, you may not have access to reliable broadband, or consumers can have a hard time because of that using fintech products and services. And then elderly customers also may have difficulty if they're not comfortable using an app on a phone, or if they don't even have a mobile phone or a computer to complete those banking services. And then, so that's access. And then there's cost. So cost is a barrier for both the banked and the unbanked. And in theory, fintech could help with this. We know one of the problems with keeping people out of the banking system are minimum balance requirements. That can be a real deterrent. Some fintech companies are offering alternatives, including FDIC insured accounts with no minimum balance, which also allows them to use direct deposit, which is a great way to ensure that your money goes into a checking account and goes into a savings account. However, for many fintech products, the true cost is not clearly disclosed, and certainly, unfortunately, small fees can add up very quickly. Another problem is erosion of consumer privacy. This is certainly an issue, and more and more data about people are gathered, stored, shared, and leveraged for a range of purposes. And when information about the use of these data is so opaque, we just don't know how it's being used. Then, of course, there's the harm caused by data breaches, which we all get those notices and kind of freak out. Another key issue, of course, is whether the new data and analytics are fair and from a discrimination standpoint. So there are big questions about the fairness of AI and whether results coming from the use of AI are actually supporting financial inclusion.
It's an excellent point. I think that the buckets that you've put this in, issues of access, cost, and privacy are really appropriate. And I think certainly ones that we see the industry working hard to address, in line too with policy. A question before we kind of dive into some of those policy issues is is when you're thinking about, what consumers should consider as they're exploring the many emerging financial management options and the tools that are out there, the fintech industry provides, what should they be considering? And also, how should the industry, how can they safeguard consumer needs by also helping promote optimal personal financial decisions for consumers?
Well, fintech providers need to be able to offer products and should only offer products after determining a consumer's ability to repay. So ability to repay should consider both the income and financial obligations of the consumer. And as failure to do so, certainly as we've seen with, payday lending and stuff, can lead to a real cycle of debt. Price transparency and unified terms and conditions are critical. The cost of credit needs to be portrayed to consumers as an annual percentage rate. We're all used to seeing that. So it's a key way of allowing consumers to compare products and make an informed and knowledgeable decision based on that APR. Loans need to be structured in an affordable way with proportional penalty fees, so the consumers can repay those loans without needing to take out another loan or borrow elsewhere. And then, of course, consumer data should only be used in a responsible manner and in a way that a consumer expects it to be used.
I think those are excellent, points and recommendations. And off of that, I just want to dive a bit deeper into some of the work that the Treasury Department has been doing to enhance oversight of consumer financial activities of non-bank firms like fintech companies to protect consumers, recognizing that this is a rapidly growing and evolving market and one that we want to be able to enable sustainable competition in. And so, in your view, are the recommendations to date that the Treasury Department has made, are they sufficient? Are they necessary? What would, on behalf of CFA, would you like to see? And how do you really think, policymakers, consumer organizations, and industry can work together to understand really the niche that this industry fills in consumer markets?
Yeah, I think this is a great question. And so let me just step back a little bit for anybody who's not familiar with the Treasury Department report and what it recommends. So they have 3 basic recommendations. They talk about addressing market integrity and safety and soundness concerns, that regulators need to provide a clear and consistently applied supervisory framework for bank and fintech relationships, and that they have to operate in compliance with the laws and regulations and risk management standards. They talk about protecting consumers, that regulators should robustly supervise bank fintech lending relationships to make sure that those are not hurting consumers' financial well-being. And then encouraging consumer beneficial innovation. Regulators should support innovations in consumer credit underwriting, designed to increase credit visibility, reduce bias, and prudently expand credit to underserved consumers. And we are support these recommendations, but we call on regulators to ensure that bank and fintech providers are abiding by all applicable, consumer protection laws. In addition, innovative financial products, including like faux earned wage access, fintech overdraft, cash advances, liquidity products, and other fintech credit, we want them to be viewed and regulated as credit. So we want to make sure that state and federal financial regulators are supervising fintech providers to ensure that they are compliant with federal and state credit and fair lending and consumer protection laws. And then, of course, not engaging in unfair discrimination or unfair, deceptive, or abusive acts or practices. We also want to make sure that regulators are closely examining evasive pricing models, including tips and inflated fees and participation fees, payment rescheduling fees, so that we can make sure that these are not being used to evade finance charges or disguise finance charges. We want state and federal regulators to consider collecting, analyzing, and publishing data so that we can all better understand and illuminate the risks associated with these products. And then state and federal regulators definitely need to work together across agencies and levels of government to ensure that consumers are protected and predatory actors are certainly held accountable.
Well, thank you. There's certainly a lot of work cut out. And, I think, especially when we think about the integration and the collaboration that has to happen at the state and federal levels, hard work ahead, but necessary and for sure. So in just a moment, I want to fit in one last question. We're going to hear from a few of our Funding Our Future partners in the fintech space. who are actively working with both employers and directly with consumers to help individuals build financial security. So, as we're thinking about the role of the consumer, I wanted to ask you, what are your short and long-term goals for the industry, and how will you measure success?
So I think success would be a competitive market that ensures that consumers are benefiting from fintech innovations. But we're concerned that we can't achieve that truly competitive market while fintech remains unregulated, because it creates this unlevel playing field with other regulated financial service providers. So we want more consumers to be able to use these products and services, but knowing that regulations and regulators are supervising the products to ensure that they're in compliance with federal and state credit and fair lending and consumer protection laws, and again, are not engaging in unlawful discrimination or unfair, abusive, or deceptive practices. And then success would also mean that data privacy laws and or rules ensure that consumer data are safe and that consumers know and control how their data are being used.
Wonderful. Well, I think we certainly have, our work cut out for us in the policy lane. But Susan, I wanted to thank you so much for helping us really lay the groundwork for today's panel discussion that is going to follow in just a few moments. And really want to congratulate you again on the successful launch of America Saves Week 2023. So thank you so much.
Appreciate it.
So at this time, I am honored to turn it over to Tim Flocka, who is a leader in the industry and who has dedicated his career to helping people build savings. He is the executive director of Commonwealth, which is a nationally recognized innovation incubator, which partners with leading financial service firms to build solutions to help people become financially secure. In his work, Tim speaks widely about the need for broader financial security and the role of fintech and innovation in addressing this need. So Tim, it is wonderful to have you here today to moderate our terrific panel of fintech leaders. So over to you.
Thank you so much, Rachel. And I just want to thank BPC for putting this panel together and mention that we're proud Fund by Future Coalition partners. And, it really is the case that we can't think about financial security at this point in history without thinking about fintech. So I'm really pleased. We have a great panel, particularly in that we have a lot of different lenses, different positions in the fintech universe. So let me just briefly introduce them by name and title, and they'll give you a little bit more on themselves when they speak. We're joined by Jane Levine, who's Chief Compliance Officer at DailyPay, by Tim Lucas, who's the Vice President of Research and Analytics at SaverLife, Doug Magnolia, who's Chief Customer Officer and President of Vestwell State Savings, and Jeff Rosenberger, who is the Chief Operating Officer at Guideline. So welcome to the panel. I want to dive right in, and I'm going to put a proposition out there and then ask each of you to respond. In our work at Commonwealth, we would say that the state of Americans' financial security is just not good. And I think we heard some of this in Rachel and Susan's conversation. One stat that I think is helpful, we did some national survey work here at Commonwealth before the pandemic in 2019, which feels like a very long time ago. But even at that point, 81% of a nationally representative survey sample ages 18 to 65 across all incomes, across all political persuasions, across all states, 81% told us that financial insecurity was a major problem. That was a jaw-dropping figure for us to realize that 4 out of 5 of us actually think this is something we need to be concerned about. I imagine most of us on this call have heard some version of the now famous Federal Reserve $400 statistic, right? That, depending on the year, about a third of us tell researchers that we would not respond to a $400 emergency by drawing on savings or even charging on our credit card. We actually disaggregated that data here on our shop by income and race and gender. And when it's 36% in the national sample, for households under $60,000, it jumps to 58%. Wouldn't handle that $400 emergency by drawing on savings. And when we look at Black households under $60,000, which by the way is just a little bit below median income, it's a jaw-dropping 72% of households. And the figures on wealth are also well known, with an 8-to-1 racial wealth gap between the median for Black and white families in terms of net worth, Another statistic is that nearly 11% of us have negative net worth. So with all of that to lead the witnesses a little bit, I just wanted to get those of you who are out there working day in and day out on the front lines in fintechs, would you agree that the state of financial security in this country is not great? And Doug, let's give you the first word on this one.
Great. Thanks so much. It's a pleasure to be here. And so I'm Doug Magnolia, Chief Customer Officer at Vestwell and president of our state savings business. Vestwell, just for a quick intro, we're a fintech and we're focused on powering savings programs for small businesses primarily and for individuals across the country. And we work through those two channels, through a workplace delivery tool and also through our state partners for helping people save with things like 529 programs or ABLE or auto IRA programs and emergency savings. So to get to your question, yeah, I wholeheartedly agree. It's always been a problem. I mean, I think the wealthy in this country have always been well catered to by the broad financial services companies, that there's no question about that. And I think where we focused a good portion of our efforts is really around retirement security. It kind of goes hand in hand. And to throw you another stat, if almost half of private sector workers in this country do not have access to a retirement program through work, these are people that are working. Almost 57 million Americans don't have access to save for retirement. That also probably means they tend to be low and middle income jobs, working for small businesses. And so there are very few avenues that they have to pursue, except through their own means of maybe approaching a large financial, whether it's their bank or a large brokerage company. And I think, as most people know, for the vast majority of Americans, it's a challenge. People feel intimidated. They feel that all of these brokerage companies are really for the wealthy, not for the average person. There's a lot of legalese and language and terms that people don't understand. So they really struggle with trying to get started down this path. So and I think, Susan, you touched on it in your comments earlier around access, the cost of these programs. Those are kind of some of the things that are critical to really help change and address this challenge for this population.
Thanks, Doug. And I'm going to keep it going. And Tim, over to you. What are your thoughts on this one?
Yeah. Hi, everyone, and thanks for having me. I'm Tim Lucas. I'm the Vice President of Research and Analytics at SaverLife. SaverLife is a fintech nonprofit that has 600,000 members across the country. They are 90% of which are below the 80% area median income threshold. We help people build a habit of saving money and building wealth. And so, our barometer for a working economy is the degree to which people are able to save money. 74% of our member base in polling says that at the end of the month, they have no income left over after their expenses to be able to put money away. In any given month, we see about 20 to 40% of our member base able to increase their savings balances by $20. So yeah, it's the ability for people to save right now is very difficult with inflation, with some of the government supports eroding over the last couple of years. One thing I would say also is that at SaverLife, we generate a lot of data. We use that data to help inform policy conversations to show what's really going on in the lives of our members.
Thanks, Tim. Jane, let's give you the next word on this one.
Sure, thanks. I'm Jane Levine, and very happy to be here. Thanks, BPC, for inviting me. I'm the Chief Compliance Officer, and I also run our government affairs work for a company called Daily Pay. And I would say that the very product that Daily Pay offers is designed to address the problem you introduced. We're in the on-demand pay industry, and what that means is people in this country who are working hard and getting paid twice a month or perhaps every 2 weeks, don't have access to the pay that they've earned except on payday. And as I think we're acknowledging, people have financial needs that don't work on that schedule. And so the product that Daily Pay offers is a way to provide people with access to money that they have already earned and worked for. So in our view, it's not a loan, it's providing funds, access to wages that really is in effect your money. We see and research that's been done about the people who use our products show it is a great contributor to reducing people's reliance on the kinds of overdraft credit, exploitive, maybe predatory lending products. People report not using them after they have access to wages or being able to handle emergencies that they otherwise would not have been able to handle. So while it's not a total solution to the problem, Daily Pay sees our product is contributing somewhat to ameliorating the issues.
Thank you, Jane. And Jeff, let's give you the last word on this question.
Great, thanks, Tim. Yeah, we do agree that it's a really significant problem facing working Americans. At Guideline, we are a retirement plan provider focused on serving small businesses. We have almost 40,000 total small business clients, and to give you some sense, over 30,000 of them have started new retirement plans or 401k plans with us. So we're very focused on this kind of access issue. How do we help small businesses help their workers, their employees save for their futures? And we acknowledge that for many of these small businesses, this is the first time that they're offering a 401k plan. And certainly, many of their workers, it's their very first time being a participant or having access to a 401k plan. So that is the way that we are kind of attacking the problem. How do we help those, the end workers in the small business get, retirement savings going in a real material way?
Thank you all. So I want to keep the conversation going. I think all of you showing up today, I'm going to assume that, none of us, it's enough to just feel like we're bringing a good product or service to the marketplace. We want to go further. We want to know that product or service actually produces real impact in our customers' lives, maybe in their communities, maybe even beyond. And yet that's not always easy, right? It's harder the further away from what you can control that you get in terms of what impact your tool, your product, your service has on households. But I wanted to get a conversation briefly going on that. How do we get beyond access and really achieve impact? And Tim, I'm going to come to you on this one first. What are your thoughts about that?
Yeah, so I think to make sure that you're achieving impact, I think one of the most important things is to make sure that there's an alignment in incentives between the bottom line of the organization and the impact goals. So that can be really different depending on what corner of fintech you sit in. But, for us, impact is just clearly the degree to which we're able to help people save more money in any given month. What's really good about being a nonprofit in this situation is that, the going concern of the organization and the impact goals are in clear alignment. But, I would implore any VC-backed for-profit fintech to really make sure that they find an impact measurement that really supports and augments the profitability measurement. And then the other thing would be simply, take advantage of the fact that technology allows you to be very, very iterative. You don't have to make the massive bet. You can make the small bet, test something out, see if it works, see if it's hitting both of those metrics at the same time, and continue to build from there. That's something that we take really, really seriously at SaverLife. We're a very small team. So we're always trying to test out small iterations to our product to see the degree to which it'll improve the savings impact of our members.
Thanks, Tim. And Jane, I'd be curious to get your thoughts on this one. Just to, taking up some of the challenges that Tim's identified about aligning your interests and your customers.
Yeah, sure. The products and services Daily Pay offers are really all about impact, not so much access to financial tools, but they have to be useful and making a difference in people's lives for people to want to use it. And I think and we, take a look at that, conducting research to find out, what are people using the service for, and we learn people, as I was saying before, use having access to their earned wages to help pay bills on time, for example, to avoid putting things on a credit card and then kind of getting into a cycle of credit card debt, or other types of products that people used to use to keep themselves financially solvent. They stopped using them because they're able to control and budget their cash flow when they need it. One thing about our product that I didn't say, we are what we call employer integrated. So we actually work through employers. We have some, very big retail chains that you've heard of, and QSR businesses, very large employers who offer this benefit through us to their workers. And we also hear from them that it has an impact on the stability of the people working at the companies. People sometimes use our product just to see, without even taking any funds from what they've earned, but just knowing, being able to see on a daily basis that they have earned money that's coming to them. It's reported that contributes even to the sort of psychological wellness. So we constantly measure that and use that information, in determining the impact we're having and what we should be doing in the direction of our product and services.
Thanks, Jane. That concept of measurement seems like it has to be part of the answer for sure. One thing I wanted to gut onto is that when we think about impact, a question that we've seen come up, and honestly, the sense of how necessary or appropriate it is for providers, fintechs or otherwise, to be in the education business or the advising business. There's actually seen a lot of change on that over the years. So I wanted to get a conversation going about that. Do you all see yourself as being in the education or advising business? And if so, how? And Jeff, let's give you the first word on that one.
Yeah, I think from our perspective in the retirement space, a big part of this is getting engagement first. So at Guideline, all our plans have auto enrollment. So, opt out versus opt in. So we see really high participation rates. And we think that's really important to get, broad usage across demographic groups. And also for workers that have never saved for retirement before, get them started, get them into the system, get them onto the platform, starting to save in their 401k plan. And then at that point, we find that they're much more willing to engage on sort of financial education topics, how to think about retirement planning, how to think about how long you'll be working, how much you need to save. So from our standpoint, it's very much like, hey, draw people in, get them engaged, and then try to meet them where they are on the financial education front.
I appreciate that phrase of meeting people where they're at for sure. Doug, I wanted to give you a chance on this one as well. What are your thoughts?
Yeah, sure. It's funny you mentioned meeting people where they are. That's part of the problem, isn't it? Trying to find the right tool and method and time to reach people. This is a challenging topic for everybody, and a lot of people, frankly, either they may have access, whether it's through a mobile device or something, but they may not have the financial literacy tools at their fingertips. And so, are you educating them or are you advising them? In our case, we're more around facilitating their access to, and then providing some tools and resources to help them make better educated decisions. A lot of the content out there can go over people's heads, and I think Tim, you mentioned the stat around the Fed data around most people don't have more than $400 to put towards an emergency savings program. So, a lot of people just don't even have any sort of investment program. So to try and keep it simple, frankly, make their choices, and it's to mention, whether it's auto enroll, but try to help the participant with simplified design and tools, so that could be user experience, that could be the way using behavioral tools to help people make easier decisions and not feel so intimidated as they're moving through a process that can really act in two ways, help drive them to take an action, as well as help educate them to feel more confident about the decisions they do take.
Thank you, Doug, for those comments. And I think what comes to mind next when we think about impact, for us at least, or for me, is no matter how good the product or service and whether it does help people learn what they want to learn and get the advice they want, if we don't find the right ways to scale up, we're never going to attack a problem, as big as we have. And so I wanted to get you all weighing in on the challenges of scaling as a fintech, and in particular, the question of, can one do that in a direct-to-consumer model? And if not, what are the alternatives? So with that, let's start that with Jane. What are your thoughts on this question of scale?
Yeah, that's a very important question, especially, at a company like Daily Pay, which is, not a not-for-profit. But and as I was describing, we kind of, I guess the phrase is B2B to C. So we integrate with employers, and that's an important piece for what we do, because we want, and the North Star of what we do is make sure we have accurate, timely information about what someone has already earned. It's not guesswork. It's not an underwriting decision. It's based on a timesheet. So the employer has that information. So we want to retain that connection, but we also want to reach as many consumers and workers as possible. And we need to make sure, or we would like people to also enroll and take advantage of the product. And so, there's an element where we're trying not only to, work with employers to talk about the benefits to their employees, but also going right out to the consumers. And, one thing I should mention, we were talking about America's Saves Week. We have sent out materials about America Saves Week to all our employers, asking them to promote this idea with their employees. We have it on social media as well, so we can, reach people directly. It's the same way. We have a tool actually on our app that allows anyone enrolled in our app to make automatic savings, every periodically or whenever they want. But that's a challenge. But we think the growth, the adoption of Daily Pay, it's a growing company, is an indication of it is scalable and doing good for people.
Thanks, Jane. Tim, I know SaverLife thinks about this. I'm interested to get your thoughts on scale, especially from a nonprofit perspective.
Yeah, I think scaling is something, we're at 600,000 members. I think we aspire to double and triple that in short order. But you need to be careful when doing it, right? So for us, we're a team of about just over 30 people. So we would love to serve all 100 million people who don't have enough liquid savings in this country. But that's a tall order. So we know that we need to segment as much as we can, right? We need to really sort of tailor our marketing to people who we know are ready to take care of our services. And then once they sign up for SaverLife, we try to put them on, the path that will work for them, is to the degree that we can. People's personal finances are so different. Everybody's personal financial situation is its own snowflake. So there's only so much individual tailoring that we can do, but as we continue to segment through every step in the savings process, we think we can help, the people that we're most ready to help, and we're trying to scale through that.
Thanks, Tim. And Doug, let's get your perspective on the scale question.
Yeah, scale is an interesting topic. I mean, it's sort of the holy grail for both public policy perspective and from the private sector's perspective too. How do you reach as many people efficiently, effectively, serve them in the right way? And so from our perspective, we kind of focus our efforts around scale, going through others essentially. And it's the B2B2C that was mentioned before. That's really the trick in our book. So we partner with our financial service providers through payroll companies and through our state partners. And if I take the states as an example, the auto IRA programs that are coming online, there's about 5 states so far that have rolled these out. They've taken this problem head on. They see that there's a problem with employees within their state that don't have access to a retirement solution. The larger companies weren't really paying attention to small businesses. And so okay, we're going to pass some legislation and put this into practice. And so we've been helping these states roll these programs out. And the biggest challenge is how do you reach all of these companies? How do you find them, educate them, get them enrolled, and then get their employee population into a program and started? So through using the state, essentially it's legislative rulemaking, it starts to make these things enforceable. That's another component to having broad acceptance of certain behavior, and that's worked really well. And you can see in the state of California where they've put some enforcement language into their program. Small business employers throughout the state, suddenly had to take an action, and I think that's helped both the state program as well as the 401k business I know guidelines. And ourselves have both benefited from employers being forced to make a decision and take an action, and then that gets people into programs. So that's been a helpful tactic in that aspect.
Thanks, Evan. I think it fits with your point that there's a public interest element of scale, and there's a private interest for the provider as well. And with that in mind, the idea that policy, which we'll talk more about in a moment, might be part of the equation is an interesting thought. I just want to take a moment and remind the audience that we're here to try and provide an interesting conversation for all of you. So if you have specific questions for any of these guests or for the panel generally, please go ahead and put them in. We'll keep track of them and answer as many as we can at the end. You can put the questions in, submit them directly through YouTube, or you can tweet with the hashtag BPC Live. So go ahead and hit us with whatever is on your mind. I want to spend a few minutes on the question of what's the role of fintech? What's the unique power or the special role that we should be looking, to what is, of course, a very diverse industry, but one that, probably can't do all things. And I think we have a chance to hear from folks how they think about this. Who are actually, fintech practitioners, if you will, leaders. Jeff, I want to give you the first word on this one. What do fintechs do exceptionally well that we should be really looking to all of you to help us with on the financial security challenge?
Yeah, I think the biggest thing is innovate and adapt to change. I think as a nudge to the rest of the financial services industry of hey, you need to move faster on things. So I'll give you 2 examples. For us in the 401k space, the advent of payroll APIs and the ability to really tightly integrate 401k plans and the deductions there with the payroll behavior and onboarding and offboarding of employees, being able to do that really, really well was a really big step forward. And there's been a lot of advancement in that area in the last 5 to 10 years. And a couple of our partners, we do this exceptionally well with, Gusto, into its QuickBooks online payroll business. They've been great partners as well. Rippling's another example, and then Square on their payroll side. So I think, moving quickly to integrate when there's technology advances would be one. And then I think the other one, actually Doug hit on it in the prior point, which is, adapt to change. What in some cases it's on the policy front too. So 2 concrete examples there on the retirement space. Doug mentioned the movement on these state programs and state mandates like Cal Savers. I think being able to adapt to that environment and mandates in some cases from certain states. And then I also think there was some major federal policy passed end of 2019, the Secure Act, and then actually just at the end of last year, follow up to that, the Secure 2.0, really impactful for the retirement space. And I'll just give you one example within that Regional Secure Act at the end of 2019. Pretty sizable tax credits for starting new 401k plans. And those only apply when you effectively offset administrative costs to the employers. And so, the right pricing model there versus asset-based pricing onto the employees takes advantage or makes best use of those tax credits. So I think, whether it's business model or technology, and if it's driven by policy change, I think those are kind of the things that fintech companies do a really great job of like adapting to and moving the industry forward, and serving, obviously the marketplace and those workers much better than previously.
Thanks, Jeff. And Doug, anything that you would add? What are your thoughts on this one?
You have to be a little careful. So I spent 30 years in large global financial institutions, and Jeff's right. Speed, agility, innovation, creativity are all words that I think fintech does really well at, and large organizations often struggle at. And not because they can't, or they're not smart enough, or not creative enough. It's just sometimes companies get too large. There's bureaucracy that's involved in fighting for resources and so on and so forth. And a smaller company can just be more nimble and move quicker. And frankly, it's a typical venture kind of mantra: fail fast, right? You can try different things. I think it's a lot more interesting A/B testing that goes on in a fintech rollout than you might see in a large corporate technology initiative. And you'll see development timelines that are more like every week rolling out feature functionality and testing it versus once every year or so. And it's that speed, that turnover, that ability to learn, from your end user, from your investor, what works, what doesn't work, why didn't that work, and hearing from, getting that feedback loop, I think is super helpful, and it allows a company who's just smaller generally and more nimble to react quicker and deliver a better solution sooner to the market.
And Doug, when you say investor in this context, you mean your end user customer, right?
End user, that's right.
Yeah, that's great. And Tim, I want to give you a word on this because you have perspective across sectors on fintech. So what are your thoughts about the unique role of fintechs?
Yeah, so I think we're hearing the case for innovation, rapid development. I spoke a little bit before about segmenting for audience, but I think that segmentation within financial services is huge, right? So I was counting the other day, I have 17 different personal financial management apps on my phone alone. They handle things from payments. I have a handful of different payments platforms, savings, investing, insurance. It runs the gamut of apps, and so I think it allows technology, and fintech means that people can really specialize in increasingly esoteric corners of financial services. Unlike big mega financial institutions that are trying to serve people in a variety of ways, but there's no way that they can just create so many different business lines. So I think that's a big one. Alerting people to the potentially low balances, right? Letting people know that they're about to overdraft. Using AI to let them know that they have an increased likelihood of seeing lower wages this month because big data allows you to look at people in the aggregate. I think that fintech can play a huge role in helping people manage a rather difficult economy. One of the things that I think that it can't necessarily do is solve many of the problems, right? When we get back to the core of our members saying that they simply don't earn enough income to cover their day-to-day expenses. Yes, there are some apps that can help with that, and yes, there are certainly apps that can help people manage tight balance sheets at home. But we still need to figure out the root cause of why many of these apps are needed in the first place, which is, cost of living is just incredibly high for our members. They're having a hard time making ends meet.
Thanks for that, Tim. I did want to just, Jeff, you had called out Secure in your comments, 1.0 and 2.0, and I can't let that moment go by without highlighting the leadership of BPC and Fund My Future in working on Secure 2.0, and in particular an issue that's near and dear to a lot of us on this call, which is enabling emergency savings. And I think it's a fair statement that fintech's played a role in showing what could happen, especially in the workplace around emergency savings. So it feels like one of the themes of this conversation today is the intersection of public policy and private initiative. And I think we're seeing that that cycle play out when we see new public policy passed, like Secure 2.0, that recognizes things that are happening in the marketplace and then tries to propel them forward with valuable new policy. So speaking of, let's take a minute and talk about policy. And what I want to pose to at least a few of you is, are consumers, this is a big generalized statement, but are they sufficiently well protected today by policy and by regulation? We heard some comments from Susan about this earlier, and I want to get some perspective from a little bit of a different angle. And Tim, I'm going to come to you first on this one. What are your thoughts?
Yes and no, I think would be my answer. I think in certain cases, it's a cat and mouse game a lot of the time with policy, right? So many protections are trying to be put in place, but I think it's really hard for the policymakers to keep up with the pace of innovation. Just look at what is happening in the crypto world right now as a prime example of that. But as I was saying before, we're still struggling with things in the policy space, especially for Americans with low to moderate incomes, to be able to take advantage of some of the advantages and some of the incentives that are out there. So if you look at the Inflation Reduction Act, for example, we're doing some research right now on the degree to which SaverLife members are able to take advantage of things like subsidies for electronic vehicles, solar. And in the handful of conversations I've had with members on this point to date, it seems like it's something that Americans with lower incomes just aren't able to take advantage of. So while that's not necessarily fintech regulation, it is regulation that's making it so that people are more reliant on fintech apps to manage day-to-day finances because they're being left out of some other important regulation.
Thanks, Tim. And Jane, from just a casual following of the earned wage space, I can imagine you have some thoughts on this. So what do you think? Are your customers well protected today, or?
Well, I when it comes to the policy discussion, I actually think the conversation that we're actually having today on this panel is sort of similar to the analysis that I think we need to do to answer that question. What's the record of benefit? And what's the record, if there is one, of consumer harm? And so if there is a record of consumer harm or vulnerability, and then we need to ask, what are the reasonable steps that we could take to provide protection without stifling or quashing the innovation and speed and all the other great things that people were just talking about. And I think that in both areas, it's probably extreme views on either side, and the truth is somewhere in the middle, that we could probably do better in some areas, but it's probably not nearly as bad as some think.
Fair enough. Appreciate the perspective. And Doug, let's get your thoughts on this one too.
Yeah, this is a delicate line. Some might say it's overregulated. Some might say it's underregulated. Fintech in general, it's a terminology. It's not a service that's being offered. So if you are providing investment advice, you are regulated by appropriate parties. If you're providing securities transactions, you're, as a broker dealer, you are being regulated just like if you were Merrill Lynch. If you are providing investment advice, you're regulated there too. So while and people kind of lump what's going on in the crypto markets and blockchain, and it gets whitewashed across all of fintech, and that's unfortunate. But it's a real harm, that's for sure. So in terms of the what we're talking about here is really helping certain parts of the population who have maybe been disenfranchised over many years, and trying to help provide access and get them into the behavior of saving for whatever purpose they might have. at the end of the day, you're opening up an investment account more often than not, and that comes with federal regulations that are required to be followed, regardless of whether you're a fintech or you're a bank or you're a broker dealer. And so this is where sometimes the rules kind of go counterintuitive to what you're trying to do. So things like customer identification policies, KYC policies, Patriot Act, OFAC, PEP, there's like a ton of different rules that you have to follow before you can open up an account for someone. And so for large portions of this population, they can tend to be unbanked or maybe have documentation issues. And so getting them into a program is often prevented by the rules that have been put in place. And so how do you marry those two often conflicting points of view? And we have these conversations with a lot of our partners all the time where state is looking at rolling out a new innovative program, and they want to focus on low and middle income people, or even people at or below the poverty line. They roll out a little pilot program, and they can't get the engagement or people into the program because they're being turned away because they can't pass certain basic rules of engagement in terms of what's required. I'm not proposing any answers. I'm just saying it's a challenge.
No, I appreciate that. We have time for one more question. I want to stick with policy, but let's go a little more half full than half empty. What is one, and I'll add the adjective, realistic policy action that you see from your perspective that could really help specifically on creating financial security for those who need it most in this country? Jane, I'm gonna come to you on this one first.
I'm not sure I have one answer to that, but I would actually echo some of the things that were said, I think by Susan up front. I personally and my company, we think privacy, information security is very important, should be baked into all financial products. Certainly should be no exemption provided for those of us doing that. Consumer protections like disclosure and transparency around fees, that's a good thing. Guardrails, access to good customer service is important. I think policy that creates a level playing field amongst those in the fintech space is a good thing. There should be an even consumer risk profile, and regulation can help with that, and we think that's a good thing. Again, I think that it's important to make sure that before taking a policy position or line that we look at the facts. I'm a lawyer, I can't help it. I look to the record and to the evidence, and what is the record? Is there a real record of harm? And if so, okay, let's address it. But if it's speculation or fear, maybe we don't clamp down on that and let consumers have access and take care of themselves. More to come on the regulatory front in the coming years, I'm sure.
Thank you, Jane. All right, with Tim, I'm going to give you just 30 seconds to weigh in, and then Jeff, you'll get the final word. So go for it, Tim.
All right, let's see if I can do this in 30 seconds. First, child tax credit. There was no question that buffered savings balances, helped people keep food on the table, helped people keep the lights on. Then the second one would be the ongoing debate over open banking and Reg 1033. Some folks want to see that open banking, the door somewhat closed. It would be very hard for a nonprofit like ours to do what we do at the scale we do it. If we have such limited access to being able to ping people when their balances are low, or letting people know when it's a good time to make a savings transfer, things like that.
Jeff?
Yeah, no, I would say just underscore, I think the Secure Act and Secure 2.0 were really big steps forward on the sort of retirement space, retirement industry. And I do think just really great bipartisan work and great work by the BPC to kind of help support and create an environment where members of Congress can have these discussions and make real progress forward. So I would say I'm keen to see what could be in a Secure 3.0 in another kind of 3 years. I do think one example of something with more and more of these state programs creating mandates for small businesses and employers to set up plans, a little more like thought on like, hey, if I have employees across states, how do we make this a little bit easier and a little less complex for small businesses to take on? And we have less of kind of a patchwork across the states, but we are supportive of the state programs to be clear. But I do think a little more like picking up and thinking about that from a holistic, more federal level would be great if we kind of fast forward to potential Secure 3.0 in a few years.
Well, thanks, Jeff. And I love the word holistic in this context. Just to repeat a theme that's come up, it's certainly our view, and maybe it's a little bit easier as a social sector actor, that when we're talking about financial security for families, especially those living on low and moderate incomes, we're not just talking about a private matter. We're talking about an issue of public concern. And that doesn't mean that we don't all need to have different actors doing different parts, but to be able to also hold in mind that we're working in something towards a goal that we all have a very direct shared interest in achieving just seems super important from where we sit. So thank you all for taking time today, coming from FinTech, but lots of different perspectives. And I want to turn it back over to Letty now, who will take us the rest of the way there. Thanks so much.
Thank you so much, Tim, and thank you to each of our panelists and to Susan for providing a unique perspective that's very important to this conversation that will surely continue. Also want to thank our audience for joining us. To learn more about our partners' important work and to discover ways to get involved, please visit our website at fundingourfuture.us. Thank you again and have a nice afternoon.